All right, today we're going to tackle a huge mistake I see all the time in auditing, one that leads to missed risks and honestly, just a ton of wasted time. It's this habit of lumping all selling expenses into one giant messy bucket. We're going to show you how to break that habit by thinking a little more like a business analyst. Okay, let's get into it.
So let me start by asking you a question. What are the invoices you get for shipping products and the money you spend sponsoring a big industry conference? What do they really have in common? Yeah, they both get coded to selling expenses, but think about it for a second. What's the real connection there?
And the answer is, well, almost nothing. And treating them like they're the same thing, part of a single population, is one of the most common and frankly most dangerous mistakes an auditor can make. It just leads to audits that are clunky, inefficient, and not very smart.
And this all comes down to one really dangerous assumption. The idea that just because things have the same account code in the general ledger, they're the same in nature. But as we're about to see, that is a massive, massive oversimplification.
So why is this such a big deal? Well, because each type of selling expense is basically its own little universe. The business flow for getting a marketing campaign approved is completely different from paying a freight company. The risks? They're worlds apart. One might be straight-up fraud, the other might be a simple date error. And that means the evidence you need, the documents you have to look at, and your entire reason for testing are all totally different.
Let's get a little more specific here. It just stands to reason, right? If the risks are different, then the rules you use to audit them have to be different too. You just can't use the same tool for every single job.
Now just look at this table for a second. It lays out the problem so clearly. For freight, your number one risk is cutoff, making sure the expense is in the right month or year. So what do you look for? A proof of delivery. Simple. But for marketing, the risk is fraud, a fake event, an invoice for nothing. You need proof of activity, like photos or event reports. And for commissions, the risk is that the math is wrong, so you need the official scheme document to recalculate it yourself. See? 3 different risks, 3 completely different kinds of evidence.
Okay, so how do we fix this? It's not about working harder, it's about thinking smarter. It means you have to adopt what we call the risk profiling mindset. So here it is. This is the big idea, risk-based profiling. It just means you stop looking at the account code and you start looking at the actual business process. You separate expenses based on what they are and the real risks they carry. This is the aha moment that's going to change everything for you.
And profiling is so essential because your audit has different goals for different expenses. For a big marketing event, your goal is to verify occurrence. You need to prove that it really happened. But for a shipment, your goal is to test cutoff, making sure it got recorded in the right accounting period. You can't achieve both of those goals with the same test. It's just not possible.
Okay, enough with the theory. Let's see how this actually works in the real world. How do you put this profiling mindset into action?
It's actually a pretty straightforward 3-step process. First, you just map out your universe. List every single type of selling expense you have, from freight to marketing to rebates. Second, you identify the risk for each one. Marketing and commissions are often high risk, while routine freight might be medium. And finally, you create your separate audit populations based on that risk and what you're trying to achieve.
And this is what you get at the end. This slide just perfectly shows the difference. On the left, you've got freight. The risk is cutoff. The purpose is to check dates. The key document is a proof of delivery. On the right, you have marketing. The risk is fraud. The purpose is to prove the event happened, and the key document is something like a photo. They are literally 2 different worlds.
Now, to make sure all of this really sticks, I want to leave you with 6 non-negotiable golden rules. If you can just remember these, I promise you'll never make that dangerous assumption again.
Here we go. 6 rules to audit by.
Rule number 1, do not mix freight with marketing, period. One is about logistics and timing. The other is a potential hotbed for fraud. They are 2 completely different animals. Second, you can't test a sales commission by looking at a shipping invoice. The documents are totally unrelated. It sounds obvious when I say it like that, but believe me, it happens.
Third, never ever assume all selling expenses are low risk. Areas like marketing, sponsorships, and rebates are highly prone to fraud and abuse. They need that extra level of scrutiny.
Fourth, there is no one-size-fits-all testing approach. Commissions demand that you recalculate them based on a scheme. Marketing demands proof that something happened. Freight demands matching rates and volumes. Each one needs its own custom procedure.
Number 5, do not treat rebates like just any other expense. They carry a very high risk related to completeness, making sure those year-end accruals are correct. This is a really common and often costly area for mistakes.
And finally, maybe the most important rule of all, no grouping things together without understanding the business flow. The process, how that expense is started, approved, and paid, that's what defines the population, not the account number on a spreadsheet.
So when you follow these rules and you really adopt this mindset, what's the big payoff? Well, you get to write a final story in your audit file that's clear, confident, and actually, intelligent. So in your final report, instead of some generic summary, you can confidently say something like this. We didn't just look at selling expenses. We broke them down into their different types, each with its own specific risks. This let us focus our testing where it matters most, making our audit way more efficient and a lot more effective.
And that is the end game, right? You deliver an audit that isn't just a check-the-box exercise. It's precise, it's intelligent, it's insightful, and it provides real, tangible value to the business because it finds the right risks in the right places. So, I'll leave you with a question to chew on. Think about your own work, whether you're in audit, finance, whatever. What big, messy, single populations have you been treating as one thing when deep down you know they probably need to be broken apart? What needs a closer look?